The S&P 500 gained 29% from its intraday low on the 23rd of March to the intraday high on the 9th of April. And that in a week which saw the World Trade Organization warning of a trade slump worse than the global financial crisis, and the IMF, the International Monetary Fund, saying this was the worst economic fallout since the Great Depression. What appears to be driving this is the massive intervention by the US Federal Reserve and the anticipation that the COVID-19 curves will peak and flatten in the developed markets. This has already happened in Europe, and although we have yet to see this in the United States, this will likely happen as well in the US in coming weeks as physical distancing and isolation works to reduce infection numbers. But for this to sustain, a number of things have to happen. Number one, COVID-19 infections have to continue falling after lockdowns are lifted. We all know how infectious COVID-19 is, so there must be a question mark over this assumption. Number two, we've got to get a rapid return of economic growth and corporate earnings after the end of the pandemic. A big risk to the V-shaped recovery scenario is the loss of income caused by economic shutdowns. The longer the shutdowns, the greater the damage to personal wealth, corporate balance sheets, and national finances, and the higher the debt levels accumulated to get through this pandemic, the slower the rebound is likely to be. Number three, there's got to be no structural damage from the economic shutdown. But the longer the shutdown, the greater the risk of structural damage. So be cautious. Big rebounds such as this are quite common in bear markets. For example, there was a 15% rebound on the S&P 500 from mid-March of 2008 to mid-May of 2008 before selling resumed. And again, after the steep falls triggered by the collapse of Lehman Brothers, there was a 20% rebound on the S&P 500 before another 34% wipeout after that. On that note, I wish you good luck in the markets, and as always, stay safe, stay well.